Right now, over 2.2 million Australians own at least one investment property. But here's the thing most people never talk about. The gap between the landlord collecting $400 a week on a single unit in Brisbane and the landlord sitting on a $10 million portfolio of 12 properties across 3 states is not just money. It's a completely different life, different problems, different tax strategies, different levels of freedom. And today, I'm going to walk you through every single level so you can see exactly where you are right now and what it actually takes to move up. Let's start at level 1, the accidental landlord. This is the most common starting point in Australia. You bought a place to live in, maybe a 2-bedroom unit in Melbourne for $550,000 back in 2021. Life changed. You got a new job, moved cities, or moved in with a partner. Instead of selling, you kept it and rented it out. Now you're collecting around $580 a week, paying a property manager 7% of that, covering strata of about $4,000 a year, landlord insurance at maybe $1,500, and your mortgage is still chewing through most of the rent. After every expense, you might be $50 to $100 a week out of pocket. You're negatively geared, which means you're making a loss on paper, and that loss reduces your taxable income. For someone on $95,000 a year, that could mean an extra $2,000 to $3,000 back at tax time. But let's be honest. At level 1, you're not really making money yet. You're holding on and hoping the property goes up in value. You own one property. You manage it mostly through your phone, and your net rental income after everything is close to zero. Level 2, the intentional investor. This is where things start to shift. You've done the sums. You've seen what happened with your first property. Maybe it's gone up $150,000 in 4 years. You realize the equity sitting in that place can be used as a deposit on property number 2. So you go to the bank, pull out 80% of the increased value, and buy a $650,000 house in Adelaide or a $500,000 townhouse in regional Queensland. Now you've got 2 properties, rent coming in from both, expenses on both. But the total picture starts to change because you're thinking about yield. That Adelaide house might be pulling 4.5% gross yield. The regional Queensland place could be pushing 5.5% or even 6%. You start learning about depreciation schedules, how a quantity surveyor can find $8,000 to $12,000 a year in paper deductions on a newer build. You're still probably negatively geared overall, but the gap is closing. Your tax return is more complex. You've got a spreadsheet now. Maybe you've set up a separate bank account just for rental income. Level 3, the portfolio builder. This is where it gets serious. You own 3 to 5 properties. You've learned how to structure loans properly, using standalone securities instead of cross-collateralization, so one bad deal doesn't put everything at risk. At this level, you start thinking about cash flow differently. You've probably got a mix. 1 or 2 negatively geared properties in growth areas like Sydney or Brisbane, and 1 or 2 positively geared properties in regional areas with yields above 6%, covering the shortfall. Your total portfolio might be worth $3 million to $4 million. Rental income across all properties could be $2,500 to $3,000 a week gross. But your holding costs, mortgages, insurance, rates, maintenance, and management fees eat a big chunk of that. The median house price across Australian capitals just crossed $1 million for the first time in early 2026. That means even a modest portfolio carries serious debt. At level 3, you're probably working with a mortgage broker who specializes in investors, and you've got an accountant who understands property. You might be looking at setting up a trust or a company structure to manage tax and protect assets. Only about 6% of property investors in Australia ever reach 3 properties. Most people stop at 1 or 2. The lending gets harder. Banks look at your serviceability differently when you've got 3 mortgages. You need higher income, lower personal debt, and strong rental appraisals to keep going. Level 4. The professional landlord. You own 6 to 10 properties. Less than 1% of Australian investors ever get here. At this level, property is no longer a side investment. It's the core engine of your wealth. Your portfolio might be worth $6 million to $10 million. You're earning $5,000 to $8,000 a week in gross rent. After all expenses, you might be netting $1,500 to $2,500 a week in actual cash flow, depending on how much equity you've built and how many properties are fully or partially paid off. You've probably refinanced multiple times. You know how to use offset accounts strategically. You might have a self-managed super fund holding 1 or 2 of the properties. Land tax is now a real consideration. In NSW, the threshold is around $1 million in combined land value before you start paying. In Victoria, it kicks in even lower. You're paying $10,000 to $30,000 a year just in land tax. At this level, you're thinking about which state to buy in next purely based on tax efficiency and yield. You diversify geographically on purpose. Perth's got gross yields around 4.3% for houses. Brisbane sits at 3.5%, but offers stronger growth. Adelaide's at 3.7%. You're matching properties to your strategy like pieces on a chessboard. Your property manager knows you by name. Your broker has your financials on file. You're not checking rental listings anymore. You're reviewing entire market reports. Level 5. The property mogul. You own more than 10 properties. At least 2,500 Australians are confirmed to hold 10 or more rental properties. Some hold 20, 30, even 50. At this level, you likely have a dedicated accountant, a solicitor, a buyer's agent, and possibly a full-time property manager on retainer. Your portfolio could be worth $15 million or more. You're thinking about development, subdivisions, dual occupancies, building granny flats on existing blocks for an extra $350 to $450 a week in rent per property. You might be borrowing through commercial lending channels instead of standard residential loans. You've probably restructured ownership across multiple entities, trusts, companies, and SMSFs to manage tax, liability, and estate planning. But here's what no one tells you about this level. The admin is relentless. Insurance claims, council compliance, tenant disputes, maintenance across a dozen properties, plumbing in Perth, roofing in Rockhampton, a vacancy in Adelaide right before Christmas. The wealth is real, but it's not passive. Not at this level. You either build a team or you burn out. If this helped you see where you stand and where you could go, subscribe to the channel and turn on notifications. Thanks for watching, and I'll see you in the next one.